Hi, Peter. Thank you so much for joining us today. It's great to have you with us. I'm Valkyrie Yao, a global media analyst, and I'll be leading today's conversation. Could you briefly introduce yourself and tell us a bit about your role and what you focus on day to day?
I'm the Chief Investment Officer with One Point BFG Wealth Partners, which is a wealth management firm with main offices in New Jersey, but many throughout the country. I manage two portfolios and I assist the investment committee and our investment team on how to best construct client portfolios for our advisors. I also write daily on the markets and the economy and anything macro. It's titled The Book Report, BOOCK Report, and that is on Substack.
So, there's a lot for investors to digest right now across earnings, geopolitics, rates, and portfolio positioning. Let's start with earnings season. When it comes to the earnings effect, is the market right now rewarding solid beats, or is it far more focused on cautious forward guidance?
It depends on what sector you're in. Of course, technology, specifically anything touching the AI ecosystem, are putting up great numbers, and those stocks are handily being rewarded. All we have to do is look at the semiconductor stocks. If you look at other parts of the market, if you miss, your stock gets beaten up. I think in general, earnings season's been very good, but it's important to sift through what's driving it. The headline number is being driven by obviously tech, but particularly some one-off other income gains with the hyperscalers. If you take that out, earnings growth is about 16, 17%. And if you take out the growth from semiconductors, growth is probably mid-single digits. So when looking at earnings growth, it's important not just to look at the headline number, but understand the things that drive it.
So a number of strategies have pointed to a split between the economy and the market when it comes to the Middle East. Why hasn't this conflict derailed stocks yet? And what do you think the breaking point would be for investors?
Well, the market's been rallying for the last 5 weeks in anticipation of a resolution to the war and a reopening of the strait. Once the White House started to signal that that is what they wanted early April, that was followed up by the ceasefire on April 8th, the market's been under the assumption that no one wanted to miss an end of war rally. So while we haven't gotten there yet, there's still these hopes. Also, of course, the AI trade has dominated both economic activity and growth, and also the stock market because of its higher concentration within the indices. So I would attribute the persistent rally and the resilience of the market to those main things.
So that disconnect is important because markets can absorb geopolitical risk for a while until it starts to affect growth, inflation, or confidence in a more visible way. And one place that often registers those intentions earlier is the bond market. The bond market is sending signals about inflation. Do current yields suggest that a soft landing is actually taking hold, or is the bond market warning us about a renewed inflation spike?
I think long end interest rates are reflecting a couple things. Certainly inflation, but also worries about growing debts and deficits because the rise is not just being seen in the US, it's also being seen in Europe, particularly the UK, Germany, France, and some others. And it's also being seen in Japan. And also, I think it's the US Treasury market because foreigners own 30% of the market. And while that's down from 50% 10 years ago, I do think treasuries have been a source of funds for some international governments and central banks that need the money to help their countries deal with a big jump in energy prices, particularly for those countries that import a lot of their needs that are seeing much, much higher costs.
So that brings us directly to policy because once yields start moving meaningfully, markets begin to reassess not just inflation, but the Fed's room to maneuver. With the new Fed chair likely to be confirmed next week, should investors expect continuity, or could this mark a more meaningful shift in interest rate policy?
I think for the rest of the year, probably continuity because Kevin Warsh is still going to have to manage a whole committee. And it does seem that most of the committee just wants to sort of play spectator and just watch how things play out. So even if Kevin wanted to cut rates, because that's where he alluded to him leaning, I think he's just going to be forced based on the circumstances in the economy and commodity prices and inflation to just sit tight for now. Now, next year, we'll have to see what happens with the balance sheet. That can be more of a change relative to the Powell committee. and Fed. I do think that one of Warsh's priorities is to figure out a way to get that smaller, both on an absolute basis and certainly relative to GDP. But we'll have to see how that plays out.
And once you bring policy into the picture, the conversation naturally moves from interpretation to action. That's really where investors have to decide how much risk they want to carry from here. And given all of these moving pieces, are you telling clients to get more defensive right now, or do you still think there is enough momentum in the market to stay aggressive in equities?
Well, when I see a market just goes straight up, particularly the tech stocks, to me that's not reason to get involved. Unless you got a willingness to understand that it's a wild momentum situation and you feel like you can get it off at the exact right moment, then fine, then you can play. I think most of our portfolios, and particularly the ones that I manage, are really more just steady Eddie. And yes, we do have some exposure to them, but I think predominantly it's a well-diversified portfolio. And me in particular, I don't own them. Those type of stocks in the semis are just way too fast for me. I'm not that exciting. So I'm more into more boring. But I acknowledge what's going on, both from an opportunity standpoint, but also from a risk standpoint, because something that goes up straight, uncorrected, gets me nervous.
And finally, I want to close on something a bit less obvious because often the signal that matters most isn't the one getting the most airtime. So, to wrap it up, what is the one under the radar metric that you think will define the rest of the year, regardless of what the Fed or earnings reports say?
Well, the US economy and the US stock market has all of their poker chips in on the development of Gen AI data centers and the hope for growth that it's going to provide because of the high concentration in terms of the stock market and the huge level of investment being made on the data center construction side. So as that goes, so goes the markets, so goes the economy. Now, that said, inflation from an economic standpoint is certainly the main pain point, and that is now having a more profound impact on the consumer, particularly with this rise in interest rates. So that also has to be a key watch as well.
Thank you. Thank you so much, Peter. Thank you for joining us. This was a really valuable conversation, and I appreciate the clarity you brought to the interaction between earnings, geopolitics, rates, and investor positioning. Thanks so much for being with us today, and thank you to everyone for tuning in. We'll see you next time on BERYL Elites.
Thanks.